Dear students, welcome back to our recorded lecture of Money and Banking course, where we will cover a part of chapter 10. This chapter is entitled as Banking and the Management of Financial Institutions, so we will cover different aspects related to the management of banking and how banks make profits. So, as usual, let's start with the main learning outcomes. In this chapter, we will explain how banks are managed to earn the highest possible profits. So we need to understand the bank balance sheet and how the bank manages its assets and liabilities to achieve the highest possible profit. We will also explain how and why banks make loans and how they acquire funds and how they manage their assets and liabilities. Also, in this chapter, we will explain how the bank manages its liquidity and its capital to avoid going to bank failure. In the end of this chapter, we will also explain how banks manage credit risks. The first point in this lecture is the bank balance sheet. And as we have seen in chapter 2, banks plays an important role in channeling funds to borrowers with productive investment opportunities. And this financial activity ensures that the financial system and the economy runs well. So banks provide loans to business to finance the purchase of a new car or home, and also it provides us with services such as checking and saving accounts. Now, let's examine the bank's balance sheet to understand how it works. So, let's start with the definition of balance sheet, which is a list of the bank assets and liabilities. And we know that total assets should equal total liabilities plus the bank capital. And assets here represents the bank uses of their funds. So they obtain more assets such as securities and loans. On the other hand, liabilities represent sources of bank funds such as borrowing or issuing deposits. And basically, banks make profits by charging an interest rate on their holding of securities and loans that is higher than the expenses on their liabilities. So here, interest rate on the liability side should be lower than the interest rate charged on the asset side. As we can see, the bank balance sheet consists of different assets and liabilities, where assets are classified into reserves or vault cash, which consists of deposits and currency. Second item is called cash items in the process of collection. Third item is deposits at other banks. Then we have securities, loans, and other assets. On the other hand, liabilities are classified into the following items: checkable deposits, non-transaction deposits, which is divided into saving account and time deposits account. Then the third item is borrowing, and the final item is the bank capital. Let's start with the liabilities side. And liabilities is defined as the funds obtained from issuing liabilities are used to purchase income earning assets. So the first item in the liabilities is the checkable deposits, which are bank accounts that allow the owner of the account to write checks to third parties. The example of these accounts are demand deposits that bank must pay immediately upon your request. So a checkable deposit is an asset for the depositor because it's a part of his or her wealth. On the other hand, because the depositors can withdraw from an account funds that the bank is obligated to pay, then checkable deposits are a liability for the bank. Checkable deposits are considered the lowest cost source of bank funds as depositors accept low interest rate to have access to a liquid asset that can be used to make transactions or purchases. And these costs include interest payments, costs of serving these accounts such as processing and storing cancelled checks, preparing and sending out monthly statement, also providing efficient tellers, either human or otherwise, also keeping impressive building and different branches at different locations. Second item in the liability side is called non-transaction deposits, and these are considered the primary source of bank funds, and for which owners of these accounts cannot write checks on them, but usually the interest rate on these types of deposits is higher than the interest rate on a checkable deposit. So here owners of these accounts prefer return over the liquidity. So here we have two basic types of non-transaction deposits, which are saving accounts and time deposits. For saving accounts, the transaction and the interest payments are recorded in a monthly statement or small book, and this book is held by the owner of this account, as we have explained in chapter 3. On the other hand, the time deposits have a fixed maturity length, and this maturity ranges from several months to over 5 years. And as we have explained earlier, if the owner withdraw the funds before the end of the maturity, he or she will lose some of the interest on these deposits. The third item in the liabilities balance sheet, or the liability sides in the balance sheet, is called borrowings, which are the funds that banks obtain by borrowing from the central bank or borrowing from other banks and corporations. And usually, when commercial banks borrow from the central banks, these loans are called discount loans, and the charge for this service is called the discount rate. Also, banks can borrow from other banks, and for this, they pay overnight interest rate or interbank interest rate. Usually, banks need to borrow for just one night to meet the required reserve ratio if they have a problem in the liquidity, as we will see when we explain the liquidity management cases. The final type of the liabilities in the bank balance sheet is called the bank capital, which represents the net wealth, which equals the difference between total assets and total liabilities. And here, the bank capitals are raised by selling new equity or stock, or from retained earnings, as we will see in the capital adequacy management part. And here we should note that bank capital is very important, caution against a drop in the value of its assets, and also it protects bank from insolvency, as we will see later in the capital adequacy management later in this chapter. What is the meaning of insolvency? It means that liabilities are higher than the assets, which means that the bank can be forced into economic failure and it should shut down. Now let's move to the items that are classified as assets in the bank balance sheet. And here the first item is called reserves, which are the deposits plus currency, which is held by banks. So all banks hold some of funds they acquire as deposits in an account at the central bank, and however, these reserves do not earn any interest. Banks hold them for two reasons. For some reserves, they are called required reserves, which are held because of reserve requirements. What is the meaning of reserve requirements? Basically, it's a regulation that for every dollar of checkable deposits at a bank, the bank must keep a certain fraction or percentage, say 10%, as reserves in the central bank, and this percentage is called the required reserve ratio. The second type of reserves is called excess reserves, where banks hold additional reserves, which is considered as the most liquid assets uh, in all bank assets. And these excess reserves can be used when the bank faces a deposit outflow, which means that uh, depositors withdraw their funds from the bank. So here again, the meaning of deposit outflow, it means a situation in which depositors withdraw their deposits from the bank. So excess reserves is very important for liquidity management, as we will see later in this chapter. Second item in the assets side is called cash items in the process of collection. To explain this, let's assume that a check is written on an account at another bank, is deposited in your bank, and the funds for this check have not been collected or received yet. Then, in this case, this check is classified as a cash item in the process of collection, and we record it in the asset side for your bank because it's a claim on another bank that will be collected in few days. Thus, when the bank receives the funds of this check, the cash items in the process of collection will fall by the amount of the check, and the funds will be recorded as reserves, as we will see later in this chapter. The third item in the asset side is called deposits at other banks, where many small banks hold deposits in larger banks in exchange of for a variety of services such as check collection, foreign exchange transaction, and help with security purchases. The fourth item in the asset side is called securities, which represent an important source of income for the bank, as we have explained in chapter 2. Then the fifth item is loans, where a loan is considered as a liability for the individual or the corporation that borrow these funds, but it is an asset from the bank point of view. Why? Because it provides income to the bank in terms of the interest payments paid by the borrower. Concerning loans, we should note that they are the least liquid asset compared with all other assets. Why? Because they cannot be converted into cash until the end of the maturity. They are also risky assets as they have the highest probability of default. What is the meaning of probability of default? It means that borrowers may not be able to return back the principal of the loan and the required interest payments. On the other hand, loans have an advantage because they earn the highest return for the bank, as banks charge the highest interest rate on loans. The final item in the asset side is called other assets, which include the physical capital, such as bank buildings, computers, and other equipment owned by the banks. Now I will stop at this point, where the rest of this chapter will be covered in the interactive lecture. Thank you for watching, and see you next week.